Hello everyone and welcome back. I just bought a new stock today. I just bought Fair Isaac FICO with my portfolio. I bought a starter position. It should be 2.6% of the portfolio, so approximately 3% of the portfolio. And that's a starter position. So I plan to increase the position in the future if the stock price drops. So I bought the dip on this quality company, and in this video I want to show you why. I want to show you what I sold to fund the acquisition and the kind of analysis I see for Fair Isaac, the kind of returns I expect out of this stock, and if I think I want to make it a core holding in my portfolio. It will be pretty interesting to you if you want to follow what is happening for this company, or if you want to get some exposure into this quality compounder. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And this is not the first time I'm buying FICO. I know the business quite well. I've been following the company for a few years now, and I bought FICO when nobody wanted to touch FICO in late 2021. And as you can see from this chart, you want to be invested, you want to buy the dip when people doubt the business model. And it seems like now people are doubting the business model again. The valuation got out of hand. Frankly, we went to an expensive level, and now we are back to a more reasonable territory. The stock is down, as I can show you here, 42%. So, what is FICO? It's the company behind the FICO scores, and we have two segments: the score segment, very profitable, very nice margins, and the software analytics segment. And frankly, nobody cares about this software segment. You can cross-sell, upsell different clients, but the fact that FICO has a software segment is not important. What is really important for FICO is the score segment. You can see that I can show you on Fiscal AI the different segments. Score segment is here. This is what is important for FICO. This is maybe the only thing that is important for FICO. This segment that is growing very, very rapidly and accelerating since 2018. It is very important because this segment is very profitable. The score operating margins are now at 88%. Let me repeat in case that's not clear for you. We are talking about a business segment growing double digits, and these margins are up from 70% to 75% to 80% to 85%. And it seems like they continue to increase. Maybe in the coming quarters, you will have operating margins, EBIT margins of 90% for a monopoly position in the US economy. And if there is a scenario where interest rates go down, a lot more people are getting more mortgage originations, they want new homes or things like this, they will apply for new FICO scores. And whether their score is high or not, you can get a loan or not. So in case there is an interest rate drop for some reasons in the future, you will have a new refinancing period in the US economy. And I would not be surprised if they can continue to increase prices, and we will see 90% operating margins for FICO. So something that grows double digits, 90% operating margins, monopolistic position in the US. And if you can look at the overall business, you will see the gross margins are at 80%, operating margins 50%, net margins 30%. All the margins are increasing massively. Revenue up and to the right, net income up and to the right, free cash flow up and to the right. We are talking about maybe the perfect business model. They are increasing their ROIC over time. ROIC is a measure for efficiency, return on invested capital, that was at 11% and then 15%, 30%, 40%, because they unlocked some tremendous pricing power in 2018. And now, based on they are doing B2B, B2C in some segments, in 2018 they unlocked immense pricing power. So the score to generate the price to generate a score, in the past it was a couple of cents, and then $1, and then $2, $5, and now it went to $10. To have a new house and have a new loan of, I don't know, hundreds of thousands of dollars, the price to generate this score, whether you will get your loan or not, is costing you $5 to $10. Nobody cares, which means there is a world where the price increases can continue. $5, $10, $20, $30. You have the legendary investor Dave Cantesaria that is talking about this. You have a legendary investor from a fund called Valuation Capital Management that is invested in FICO, has been investing in FICO for a few years now, and that is seeing immense pricing power. And he thinks the cost per scores can go up to $40. Up to $40, but it can go by more than this. That's his biggest position because the stock price has gone up so much. And despite the stock price going down and down and down, he is not trimming. So you have one legendary investor with deep knowledge of the business, holding conviction even though the stock goes down. That tells you a lot about what he thinks FICO will generate in the future. And I'm sharing this view. I'm sharing the view that FICO can continue increasing their prices. They can keep their monopolistic position, which means the free cash flow can continue to grow at 20% per year or more. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. And what do they do with their free cash flow? Do they do acquisitions? No. Do they pay a dividend? No. Do they have, even with the operating cash flow, do you have massive capex? No. All the free cash flow is used to do buybacks. All the free cash flow, all the operating cash flow actually, because the company has zero capex. I can show you on my custom metric the allocation of operating cash flow. What is the business doing with all its cash? I can show you the percentage of buybacks compared to operating cash flow. I can show you the dividends, and I can show you maybe the capex or even the M&A. Here is what you have. This is messy. Don't worry, I will explain how everything goes. On the last 12 months basis, this is what we have for the past 10 years. You can see that in the past, you had a small orange line because the company paid a tiny dividend, and they stopped the dividend payment in 2017 because they said it was not tax efficient, and I agree with them. So let's remove this line. And then you have a small line M&A. In the past, they did some small M&A activities, and they are no longer doing this. So no M&A, no acquisitions. What is remaining is in orange here at the right, the capex. 5% of the operating cash flows are used to fund internal growth, 5%. And now we are speaking. 200% of the operating cash flows are used to do buybacks. The company is using more than 100% of the cash flows to fund buybacks. They are very aggressive. And because they can't fund everything internally, they are using debt. As you can see here in red, the debt level is going higher and higher and higher and higher. This is a company that knows what they are doing, and they are aggressively taking on more debt to generate massive buybacks. Is it smart or not? Well, it depends. It's not perfect, in my opinion. In 2021, 2022, the stock was down a lot. The valuation was cheap. So it made sense to increase the buybacks meaningfully and increase the amount of debt. But then, I can show you the valuation at the same time. I can show you the forward P ratio, forward price to free cash flow. We are talking about the same things here. As I can show you here, in late 2021, beginning 2022, the forward price to free cash flow went down from 50 to 25. and they increased the buyback program immensely. It makes sense. And then the valuation went up, the stock price went up in late 2024, a forward price to free cash flow of 70, and the management continued to repurchase a lot of shares. More than 100% of the operating cash flows were used to do buybacks. I don't like this, okay? I don't think that's the most efficient use of your capital. Maybe they should have stopped anyway. Nobody's perfect. And now, as the stock is dropping, the valuation is dropping, the forward price to free cash flow went from 77 to now 28, and I bought at 28. Now, I think it makes a lot of sense for the management team to ramp up buybacks. I think this is very smart to repurchase as many shares as you can. When your forward price to free cash flow is below 30, we are in a sweet spot. A lot of growth is expected. The monopolistic position is not touchable right now. Impossible to disrupt this industry. You have some risk, some worries. I'm pretty much aware of this. But actually, I like what I see. Now, people are cautious when it comes to FICO for several reasons. And this is the reason why the valuation has dropped. One, trees don't grow to the sky. The valuation was extremely high, so you have to come back to reality. Two, you have SaaS apocalypse. As I told you before, FICO has a software segment, so maybe this software segment may get disrupted by AI. That's a worry, and that's a reason why the stock price is dropping. Three, you have another AI worry when it comes to scores. People think that with Claude, Anthropic, you will be able to generate an AI score, and this is maybe the disruption risk for FICO. I think people underestimate the moat of FICO. People don't use FICO scores because that's the best score. People use FICO scores because they've been using FICO scores for more than 50 years. Every banker knows what a FICO score is. Every middle-aged or even an old banker knows what a FICO score is. Regardless of your age, you understand. We are speaking the same language. It's not about who has the best tech, okay? It's either, imagine you are a banker that is 65 years old. Either you use a new AI score generated by Claude, or you use a FICO score. Which one will you choose? It's a language, and they have a market share of 98% for FICO scores. So 98% of all the banks speak the same language. It will be very hard to disrupt this industry, right? This is why it's such a big monopoly, beautiful monopoly. So a third reason. Fourth reason, you have some tweets from Bill Pulte, somebody from the US administration that was not very happy with monopolistic behaviors and price increases. So in summer 2025, as you can see, the valuation dropped meaningfully. You had a couple of tweets, and every tweet from this person made the stock price drop a lot. So crash 10% in one day, and then a rebound at 10% in one day. And it seems like now, you wait a couple of months, FICO just announced a new price increase, and we had a new tweet from the same person congratulating Fair Isaac, saying how great it was for competitive pressures. So it seems like people freaked out over a couple of tweets. And I remember we were talking about this inside my coaching program, saying it's only noise, it's not signal, it's not important. You will see how short-term these moves are. It turns out now you have new price increases, and the same person is saying congratulations, it's wonderful, great for the environment. Fifth reason why the stock is down, you have some competitive pressures from the Vantage score, and the credit bureaus, they want to have a new scoring system. Anyway, the Vantage score has been here since 2004, 2006. It's been there for 20 years, and still FICO has a monopoly. So I don't think it will change the story at all. Maybe people will use two scores to judge this anyway. 6, and I'm seeing this very recently with the rise of AI and banks that are using their own data to have their own scores. There is a worry that not everybody can have a FICO score. because to have a FICO score, you need history. How fast did you repay your old loan? And it's backward looking to generate a good score. Now banks are having internal data, and it's not backward looking. They can check in real time at present if you are a good customer or not, if you deserve a loan or not. So people think with the rise of AI, with buy now, pay later, new tools, you can generate new risk models and new scoring systems. I heard exactly the same thing back in the days in 2021. So I'm not worried about people saying this at all. I know this is the bear case for a lot of people that don't think FICO will thrive, but I heard the exact same arguments in 2021 with the rise of Upstart. Now nobody remembers Upstart, but it was a key differentiator between this company called Upstart back in the days. They said FICO scores are too restrictive. What if you never had a loan before? What if you are 20 years old, a student, and you need a loan? Well, this was their theory, and they used machine learning at the time, so an equivalent of AI, to generate a better score. Their score was better, but still, nobody cared. And at the time, Upstart, look at the stock price at the time, 2021, the PE ratio of Upstart was 400. People forget this too fast, but you had this clear change in narrative in late 2021 that Upstart and other companies were about to disrupt Fair Isaac and their FICO score ecosystem. And actually, it was quite threatening because Upstart was growing a lot. Look at the revenue. Look at the revenue here in blue. 2019, 2020, 2021, the revenue skyrocketed, quadrupled, and the company became profitable for the first time ever. So yes, you had a potential competitor growing a lot, being profitable, widely profitable, and now that we have history, the track record, see what happened. The revenue is now down since then. The clear disruptor is now having less revenue than 5 years ago. And what about the net income? The business was profitable for only 1 year. And then guess what? It's harder than expected to be in this industry. And since then, since 2021, they are now burning cash, losing money, having losses and losses and losses, and they are taking more debt to survive. And they are diluting shareholders every year. They are diluting the shareholders 14%, and then a buyback of 3%, and then they added 6% more shares, and then they diluted 8% more shares. So yeah, I think the worries people have for FICO are very much short-term oriented, and all the risks are short-term. With that said, now that I have pretty much conviction that the monopoly will be here in the future, is the business cheap? You can look at 2021 when the company was being doubted. We went as low as a forward price to free cash flow of 17. So let's say it was roughly 20. Now we are not at 20. So it's not as cheap as it was back in the days in late 2021. But we are getting back to a reasonable valuation. A forward price to free cash flow of 28. Fair enough. A lot of growth is expected. The company has a guidance for 2026 to grow earnings per share at 26%. I think they will do more than this. I think earnings per share for 2026 will grow at 30% per year. And I think FICO has the potential to grow 20% per year for many years to come. So, if you put these estimates in a DCF, you can estimate an intrinsic value and you can estimate potential returns. By the way, you see me use Fiscal AI to show you all the chart. You can use a link in my description to try Fiscal AI for free for 2 weeks. No, without putting your credit card. Just try it out, see if you like it, okay? And for this DCF model, I will use Stock Unlock. Similarly, you can use Stock Unlock and use a discount code in my description. So, If we say the free cash flow of the business will grow at 20% per year, and we expect a price to free cash flow of 30, they will continue to do buybacks. If these are our estimates, then the stock right now is 20% undervalued. The fair value is $1,700, as you can see here at the right of the screen. And the CAGR, the compound annual growth rate I am expecting right now, because I bought today, is 15% per year. Now let me show you something else. Let me show you not the forward price to free cash flow, if you take into account the guidance and the future growth, but the normal price to free cash flow. You can see that it is widely fluctuating. For the past 10 years, widely fluctuating. Since 2018, the business changed. They unlocked this new pricing power. The price to free cash flow went as up as 50, and then it dropped to 20, 25, and then in 2024 it went to 90. Now it's back to 40, which means it will continue to fluctuate a lot. Since the new pricing model, since 2018, what has been the average and the median price to free cash flow? The median has been 40. So maybe the real intrinsic value of FICO is not a price to free cash flow of 30. Maybe it's a little bit more than this because it deserves a premium valuation because it's a monopoly. Okay, just let me put the best case scenario. This is this one with the price to free cash flow of 30. This is maybe my base case scenario. So my base case scenario is I make 15% per year. But something can happen and FICO can reaccelerate for any reason, and maybe they will deserve a price to free cash flow of 35. If this is the case, and you think the company deserves a premium, then the stock is now 40% undervalued. And if you buy right now, you can expect a CAGR, a compound annual growth rate of 18% per year. I think this is a scenario that can happen. And you can talk about a bear case scenario. What if it deserves a lower multiple? What if we have a recession? Yeah, that's good enough. Then if you buy right now, you can expect a CAGR of 10% per year. Based on different scenarios, several things can happen. And then there is an ultimate bull case scenario that has a non-zero probability chance of happening. What I said before, what if interest rates in the US go down? Not this year, maybe not next year, but in the coming years. What if you have a new refinancing period for the US? And what if a lot more people buy homes, they get credit, they get new loans, and the whole industry is accelerating? In this scenario, I think the free cash flow of the business will not grow at 20% per year, but more than this. Actually, more than this. They will maybe grow 25% per year, and the stock will deserve a premium valuation because it will grow so fast. Price to free cash flow of 35. This is speculative, okay? Don't think this is my base case. I think it is not certain it will happen, but it's maybe happening in a few years. If this is your ultimate bullish scenario, people will salivate. Because if you think this will happen, the stock is 70% undervalued. And if you buy right now, you can expect a compound annual growth rate of 23% per year. So yeah, it's pretty enticing, but I think it has some probabilities of happening. Nobody knows. My best case scenario is making 15% per year, and the upside potential is just a bonus. I started the position and I made it a 2.6% allocation in my portfolio as a starter position because the stock is not cheap. Okay? Why is the valuation stopping in late 2025? Strangely enough, yeah, here is what we have. Now, here is the normal price to free cash flow we have for the business if you don't take into account the guidance. And I can show you the forward price to free cash flow to show you the valuation if you take into account the guidance. 28. It's roughly 28. It's not precisely 28, but I calculated it to be roughly 30. My point is the same. We are at a reasonable valuation. So I opened a first tranche and I bought 2.5%, let's say 3%. To fund this buy, I completely sold out of Amazon. I no longer have Amazon in my portfolio. I completely sold out of Amazon. I have enough hyperscalers with Google, that is 11% of my portfolio, and Meta, that is 10% of my portfolio. So I'm happy with that. I don't want Amazon in my portfolio. And I shift my portfolio to be more asset light with zero capex. So obviously, Amazon does not fit my criteria of having minimal capex. FICO has minimal capex. I showed you before. If FICO goes up, I will not buy more. If FICO goes down, I will buy more. If FICO goes down and the forward price to free cash flow, the line in orange, goes from 28 to 25, 24, I will buy a second time and make it, I don't know, from a 3% position to a 6% position. I will double the position. If after this FICO stock goes down again, I will buy again because I have a lot of conviction in this monopoly and I would not hesitate to make it a core position in my portfolio. I already know what I want to sell to fund this acquisition. I will let you know in a future video. But if the stock price continues to drop, I will buy more. And actually, I hope it goes down because I want to be invested for the long term. So I want to be in the red. I want the valuation to drop and drop and drop and drop again. I would be very happy if the forward price to free cash flow goes from 28 to 25, I buy, it continues to drop, 23, I buy, it continues to drop to 20, I will make it a huge position if I have a price to free cash flow, a forward price to free cash flow of 20 actually. A huge position, like more than 10% of my portfolio, because I have a lot of conviction. I've been following the company for more than 5 years, so I understand the business quite well, and I have built conviction for the past few years. I think if it drops meaningfully, it has the potential to generate 25% per year for many years. So I would prefer actually for the stock price to go down. And if the stock price rebounds from there, if I bottom ticked it absolutely, so be it. I will just let it run, but it will go back to being expensive again, so I don't want to touch it. I hope the software sell-off continues, so Fair Isaac continues to go down so I can buy more. But yeah, I will let you know if I have any updates, but this is the latest stock I just bought. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.